Welcome, everyone. Hopefully, we have people joining from all different time zones and all different areas because I think you would all agree with me that some of the responses I'm going to give are just generalized and it may vary from location to location. So, um, just so we all know what's going on. This is me. I'm Michelle White. I'm the Director of Real Estate Service Experts at the CE Shop. I've been in the business for over 30 years. I've kind of done a little bit of it all. I'm sure a lot of you have been in the business as well. And you remember when times weren't so great and when times were really great. And looking back helps us look forward. So I'm use my history in the industry to help me basically predict. We'll see. We'll see how accurate I am. And you can hold me to that. So next year, if my predictions don't come true, you can find me. Um, I do have a master's in education, and I took my education knowledge and my mortgage knowledge and kind of fit it in like a puzzle. And now I am working here at the CE Shop. I'm the instructor of record and the subject matter expert for all of the mortgage courses here. And it's been a great experience for me. So let's talk about 2026. Let's jump right into it here. So we're going to talk about rates and inventory. We're going to talk a little bit about some predictions on Bitcoin and cryptocurrency, some policy shifts to be aware of, affordability, which is something that I was just reading an article about a few minutes ago, so I might throw some of those numbers in as well, and then some resources that you can maybe use to stay ahead of the game. So rates and inventory, this is a really interesting one. Where do I think rates are headed in 2026? Well, if you're old enough to remember a magic 8 ball, I looked around for mine, but I'm pretty sure it's in a box somewhere in the basement. But depending on where you're joining from, you could be hearing a lot of different things about rates. Um, I think, my opinion only, that we are going to be staying in that right around the 6% range heading into Q1, Q2 of 2026. When you look at what's going on in the market right now, I do think we will see some bouncing down and bouncing back up. I don't believe we'll get back into the 4% range in 2026. Now, I did just read an article that might impact that. According to a recent article released just recently within the last week about only uh, less than 20% of the market right now is first-time home buyers because they simply can't afford it. And the rest of the market is varying in what their position is within the market. If they're, second-time home buyers or investors, if they're downsizing. So that also kind of talks to what we can expect for inventory. And again, depending on your area of the country, having worked on the nonprofit side at one point in time in the past, I completely understand the push to create housing that is absolutely affordable to the first-time homebuyer or to lower income families. Housing stability is so important to communities. It's important to families, proper child development. So when we're looking at housing affordability, it is so important, I think, that we're going to be addressing a little bit more. So in some areas, particularly where I'm at, I live in one of the oldest demographic states in the country. Um, in our area, the plan is to build more senior affordable housing in hopes that will prompt seniors to sell, free up their homes, their houses for purchase by the next generation. I'm not sure that's going to fix inventory anytime soon. And as for inventory, I do think we'll see an increase in inventory in most areas across the country. It's going to be slow coming. We will find that some of these are going to be coming from a slight rise. We're seeing a slight rise in foreclosures, not by much, just a couple percent, but I do think we could see some more of it coming up. But my overall prediction is that inventory will slowly increase, whether that's through people selling or even through new construction. What should you be looking for in Q1 and Q2 of 2026? Well, gosh, there's so many things that we really need to keep our eyes on right now. I think a lot of different markets, mortgage, real estate, and all the mortgage and real estate adjacent industries, um, are going through some changes right now. And there's a lot of kind of upheaval. We're trying to figure out how to get it all done and keep things going. So I think we'll see some adjustments to rates. I think we will see, kind of keeping an eye on that inventory. And I think a big thing that we will see in Q1 and Q2 of 2026, hopefully, is some new lending programs. We are back around to getting a little bit more creative in our lending opportunities for our borrowers so that we can continue to get some of those moderate to low income people qualified for that home ownership journey that they want to take. Maybe some increases in funding for some DPA programs. The down payment assistance programs, I think, are going to keep coming. I think there's going to be more grants, more opportunities, more community action agencies that are kind of throwing programs out there and trying to gather together as much money as they can so that they can continue to help people achieve that goal of homeownership. I keep an eye on NMLS, and I think we're going to see licensing fees and education requirements changing. We're also getting some updates out of a couple states like Utah and a few other places that some of their education requirements for MLOs, whether that's to be licensed for, lending manager positions, different requirements, different positions within the industry, and some additional state requirements, because I think we're going to start to see some states break off and make some of their own rules at this point. FICO scores. Let's talk about that. We now have FICO going kind of public, right? They're doing this direct licensing program, and there's some merit to it. I think there's also going to be some concerns with it. There are some laws tied to credit scores and tied to rapid rescores that may need to be looked at in order to accommodate this new pricing model and the new scoring model of the direct licensing for FICO scores. Changes regarding what can be reported on a credit report. I think we'll see some more information about that. Some of the alternative scoring algorithms that are being put out there. I think part of the reason that FICO has gone to this direct licensing program is because they are being challenged by some other scoring models that might become important or might change the way we look at and evaluate credit risk in mortgage lending. Policy shifts. Whew. What is on the horizon from Washington? We can't help but mention the government shutdown. If you are in an area that is a USDA predominant area, where I'm at, we have exactly 6 zip codes in the entire state that do not qualify for USDA. Otherwise, the whole entire state qualifies, right? So we have a significant number of USDA loans. Well, right now, USDA is at a complete standstill. With the government shut down, they have no funding. You can still submit your GUS, you can still reach out, but they're not guaranteeing any loans. If they're issuing a certificate of guarantee, it is a subject to appropriate funding. As a lender, I wouldn't want to close a loan with USDA until I know I'm going to be able to get that certificate, especially if we're service release or if we're transferring servicing, selling to an investor. They are likely not to buy it unless they know that they have that guarantee certificate. Um, FHA and other government programs, they're maybe not shut down, but because of furloughs and other things going on, they are extremely slowed down in some areas. Um, Another thing to think about is the real estate markets in areas where there's a high number of government employees or government furloughed employees may be impacted. And it goes beyond that too, as we all know. Verifying Social Security income might be delayed. The National Flood Insurance Program isn't writing policies right now, and buyers can still get that private policy, but we all know that's a little bit more expensive and it does impact their ratios. And even when we get back to business, there's going to be a period of time when a lot of that is going to have to, be a catch up, right? We're going to have to catch up on that. If we talk about potential regulation and compliance changes to be aware of, again, the direct licensing program from FICO, I think, is something that is going to have to be addressed because regulations specifically call out, no rapid recheck fees. Well, it's not really a rapid recheck fee because we're doing a direct licensing and we're cutting out that middleman. So I think there's going to have to be some policy changes to make that particular program work. What about cryptocurrency as assets? I think this is an interesting policy. We do know that the Federal Housing Finance Authority is pushing to have Bitcoin and other types of cryptocurrencies used as reserves, and Fannie and Freddie have been put on notice to develop internal frameworks to evaluate cryptocurrency. So those are some policy changes that I think are coming up, and I think that they will become an important part of 2026. And again, though, remember that cryptocurrency is extremely volatile, up and down, probably even more so than stocks and other investments. In fact, I read an article just this morning that the cryptocurrency market is really dropping off right now. So if you have some crypto, check on your accounts. We're also looking at a lot of other opportunities, reg changes that may be coming as far as qualification. And as always, every year we get our income limits and our purchase price limits. And with the increase so quickly in the housing market and appraised values, we may see quite a jump. So that's something that I think we should keep our eye on, is how high those are going to go this year. And how can brokers stay informed on these changes? Well, I have signed up for every newsletter that I can get my hands on from national and state regulatory agencies, national and state lawmaking agencies and divisions. It's a lot of paying attention, a lot of reading, a lot of networking, connecting with your local associations. I am a member of my local association here, and they put out regulatory newsletter. So we have someone that watches that stuff for us. So if you're not connected to your local agencies, professional associations, maybe make that connection and at least get on their newsletter list. Attend industry events and webinars like this one. I will also be going to the CSBS NMLS conference in February to see what I can find there. I read a lot of industry publications and I talk to mortgage adjacent industries. So I do talk to my real estate people in the area, and I do talk to some bank people in the area, in particular because here in our state, um, a majority of the loans, probably 70% or more, are made through banks and credit unions, not those non-bank entities. So that's something that I try to stay connected with just because I know that's where a majority of business in this area goes. Cryptocurrency and mortgage. This is something I just wanted to dive in a little bit more because, um, you know, the FHFA has recognized Bitcoin and other approved cryptocurrencies as reserves. And Fannie and Freddie are supposed to be building this framework so that they can be used as reserves without having to liquidate them. So in their digital form. But how do we track the digital form? I think there's going to be a lot of questions. Um, Digital assets are considered a legitimate source of assets for a lot of programs. And in particular, one piece of legislation, the 21st Century Mortgage Act, if it gets passed, will require the GSEs to allow for digital assets, uh, among other initiatives intended to increase housing availability. Obviously, the benefits are those people that have that asset, it's going to give them those reserves. So if they have money to put down, they've got some down payment. As always in the industry, having a good amount of reserves really helps your application. It really helps you get qualified for a loan. It's a great compensating factor. And in fact, some of the mortgage companies require, well, if you're going to only put down this much, then we want you to have this much, 6 months in reserves, whatever it is. Now, the question is, will Arch, will Essent, will any of the other investors, will any of the other mortgage insurance companies come on board and accept those cryptocurrencies? From my underwriter perspective, which I always like to fall back on, how much credit do you give? Do we give, a percentage of it? Do we say we're only going to count 75% or 80% of your crypto because we know it's got a fluctuation? So I think there's going to be some policy changes and some figuring out to do when it comes to cryptocurrency. And I would be interested at the end when we do a little Q&A if somebody wants to just tell me if they have started using that, if they are using programs where cryptocurrency is actually being used as an asset. Regulations that are going to have to change with that. I think we're going to have to define cryptocurrency. And when we talk about assets, we're going to have to talk about how we calculate those, as far as mortgage regulations. I also believe that there are some other regulations, and again, I'm going to NMLS CSBS conference in February. They're going to have some sessions that are going to be talking about cryptocurrency and mortgage and Bitcoin and how that all kind of comes together. And also, who needs to be licensed to deal in cryptocurrency, and will NMLS be involved in issuing those licenses and maintaining those licenses, because it is not a bank, but it is a financial service. So I think NMLS is going to have some more tracking on their hands for licensing and what those licenses are going to look like. So there'll be some regulations around licensing of people who will be dealing cryptocurrency. And then, bank accounts have been around for hundreds of years, 100 years or so. Cryptocurrency has only really been around since 2009. Um, I do see us using digital assets, but I think it's going to be a process to get everybody accepting it. Some of us still don't even like AI, and now you're talking about not real money. So some of us that have been in the business a while, or some of us that are a little more on the conservative side of lending, are going to want some pretty strong verbiage to be used in that. Affordability. This is like a buzzword, right? Everybody wants to know what affordability is, how we're going to make homes more affordable. There's a lot out there. There's a lot of housing stock, but is it affordable? And the affordable stuff, is it really livable? And how do we keep affordability? So we can't really undo what's been done when it comes to this sudden and significant increase in property values that a lot of areas have experienced, right? In the last, 18 to 24 months, we've seen a more than normal increase in property values. Um, so how do we make homeownership more affordable? Well, rates. Lower rates would make things more affordable, but that's not a guarantee. Nobody can predict what rates are going to do. Um, I also don't know what affordability is really going to look like in the long term. Prices and costs of things are going up quicker than income is going up. And so there's still that gap that we're seeing. Some creative strategies to help your clients achieve homeownership goals. I think we're coming into an era where some of those homes that might be left over from the crash that have been vacant for several years are going to be interesting to some buyers. Can I buy this older home? Can I buy this rundown property? Is it cheaper for me to buy this, do it as a complete tear down and rebuild than it is to go out and buy something that's, you know, move-in ready right now? So I would say look at those FHA 203K rehab loans. Look at some of the community reinvestment programs that might be in your area where someone can buy a house that's a little run down or needs work, and the community is willing to donate into that or give into that. Um, Make sure that you are educate, 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 educate. Um, Educate yourselves about what's available out there, what loan programs you have available to you, what investors are doing, what programs. Really get to know your borrowers, educate yourself on them, their needs, their limitations, their long-term goals, and then educate them. Keep them educated about the programs so that they're not surprised by anything that comes up. And you can, kind of form a team to work together to make those homes affordable for them. We can look to community action agency programs. I think we'll see more of those coming up, like I said earlier. And I do think that the DPA programs also are going to be increasing. We saw 2,500, 3,000, and that was just 5 years ago. And now a lot of those DPA programs are up to 10 or 15,000, especially for those individuals buying those 1 to 4 family units that they're going to occupy as an owner occupant of the building. I've seen DPA programs up to $20,000 if you're willing to do a little bit of work, a little bit of education, take some classes, especially new landlord classes, those kinds of things, and then have some tenants in your building. Uh, One thing that I am seeing too a lot of is crowdfunding for down payments. So if you have a borrower you're working with, they're not going to have enough money. Maybe they just got married, maybe they just got engaged. There are some loans out there that specifically are built around crowdfunding for down payment options. Housing authority loans are always a decent option. There's always some type of lower rate or some type of DPA associated with those. Or here's an idea. Find an investor or a company or someone out there that will work with you specifically to create a program that's going to help an underserved portion of the population or underserved demographic. If you know that there's an underserved piece of the population, there's probably a company that will help you be the spearhead to get that program up and running. Get creative yourselves. You know the industry, you know the business, you know what people need and what kind of programs can actually help. One interesting program that I read about was a town created program, right? So that they had all these homes that were behind in the taxes. Maybe people passed, maybe they just moved out of the area, they didn't care about it. They took all these properties back on tax liens. And then the community could apply to purchase these homes for just the tax value of the home. So maybe there was 20, 25, 30,000 owed in back taxes. And then they could work down payment money by doing community service hours at the town. And then the lender would come in and lend them the money for the remaining down payment and for the remaining purchase price of the loan, and then also for improvements. So get creative, figure out something. We know this business better than anybody. We've been doing it for a lot of years, and it's up to us to let other people know what we need for programs. So this is this next question, the role of brokers in providing homeownership education as well as mortgage guidance. Many consumers are educating themselves, right? They're going out on the internet, they're looking stuff up, they go to the Google, and they put stuff in and they read and they think they understand what they're reading. And sometimes they do, and sometimes they don't. Or they're consulting with friends and family about building their credit score, how to save money, and how loans work, right? Everybody has an opinion and everybody has a guy. I got a guy for you. I got a guy who can help you fix your credit. He's a garbage man and picks up trash, but on the weekends he counsels people on how, teaches them how he fixed his credit. So it must work for everybody. Everybody's got a guy and everybody knows how to take care of that for you. Family and friends and Reddit, they don't all have the best advice, right? Or it may be accurate. It may not be as up to date. Nana and Papa bought their house back in the 1950s, and buying a house today is significantly different, but they have an opinion on it. So it's up to us to make sure that we're managing the borrower expectations from day one when we start talking to them. It starts with basic education and correcting the basic information that they think they know based on their family and friends and the guy they talk to, and peach cobbler 123 on Reddit, I guess. And then as the loan progresses, or as your relationship with that borrower, that potential borrower progresses, the education gets a little bit more detailed. Um, and so you have to get a little bit more detailed, and they have to be more open to what it is you're saying. One of the easiest ways to provide education to potential homeowners, I think, is to meet them where they're at in their process, where they're at in what their expectations are, and also to kind of read them. If they're fast talkers, you got to be a fast talker. If they prefer to read a pamphlet or a book, you got to have those resources available for them. So part of providing good homeownership education is having the information available or resources available to provide those consumers with the information they need in a form that they can actually consume and process and understand. Uh, you may also um, have some success educating potential homeowners by becoming involved in your community, right? Become involved in education even before the transaction, even before you've met someone. Write your own course, basic education for, buying a home 101, and propose it to your local adult education. Whether that's at the local high school, the local trade school, the local college. Usually every area has some adult education classes that you can take. Why not? Uh, Start your own podcast, start your own YouTube channel, um, be a resource even before the process begins. Give talks at your local library about programs. If you're someone who does reverse mortgages, if you're someone who does is very knowledgeable and has a source for them, and you understand the HECM loans and the process, maybe set up with some type of financial advisor or estate planning guy or girl out there to take 15 minutes out of their monthly talk they give to talk about HECM loans. That's going and meeting that consumer where they are, figuratively and literally. Um, I think I already mentioned managing expectations. That was a note that I had there. I think the biggest problem I faced when I was originating, everybody wants that horse property, everybody wants that condo on the golf course, but not everybody's going to be able to afford that. So communicating clearly and communicating often with the consumer, especially once you've taken their application, I think is a really great way to guide them through the process. Um, and then just understand that your contact with your borrowers may not stop when they get their keys, because you help them through the process. They may decide they want to come back to you. They feel comfortable with you. They've built a relationship with you. That's your circle of influence. We've all heard that. We've all listened to probably to the Zig Ziglars out there in the world about how to, establish your circle of influence and how to keep those referrals coming in and how to stay active on those things. Um, I will say, at the CE shop, we do have a lot of great writers and bloggers. We have a lot of people who do a lot of research. We have blogs that go out and newsletters that go out. You're welcome to sign up for any of ours as well. We're also working on a professional development program. If you have ideas about things that you want us to teach you, please let us know. We're happy to take that information. I would love to open up the chat line and see if there are any questions or any comments about anything I said. I am happy to openly discuss all opinions on any of the topics that we've covered so far. Let's see, we've got California, Florida, Georgia, Tennessee, Hawaii. Aloha. I lived there for 3 years. It was beautiful, and I wish I could live there again. Colorado. Absolutely love Colorado. Have lots of friends there. New Orleans is not someplace I've ever been. So um, hopefully we'll get there someday. Oregon, I've been to, Nevada. Wow, we have a great range from one coast to the other and back again. And it looks from like up north to down south. Arizona lived there. Texas in all caps with an exclamation point. I guess that's the way. Let's see. Yes, I will let you know at the beginning, and I'll repeat it now. About 24 hours or so after the end of the webinar, there will be a recording made available um, on everything that we've gone over. Anybody, just let me know if you've done any cryptocurrency. That would be an interesting one that I would love to learn about if you've done a loan and used crypto as an asset, how that went for you. Interested to see what your take on education is and rates. If you have any comments on those, happy to address them. Ah, you're a quiet group. Just monitoring the chat here for a few minutes. Please talk about Vantage score versus FICO score. Oh, wow. So if you haven't heard of a Vantage score, it's a little bit different scoring model. It uses different algorithms and different formulas to create um, a risk factor score, right? FICO, we all know, is the Fair Isaac score, and that's been around for a long time. And it used to be the gold standard. And some industries now are talking more about a Vantage score. From my understanding, and I could be way off because a lot of stuff I read a lot, um, they're just a different way of looking at credit, a different way of looking at certain factors, the available credit. And when we look at a FICO score, you're getting a percentage of the score is based on available credit, late payments, out how much is owed, age of the oldest accounts, and the Vantage score is very similar, but the Vantage score is using different percentages. It's weighing differently how long you've been using credit versus how many late payments you've had, and whether it was one late payment 30 days ago or one late payment 5 years ago. So they are very similar. It's just really looking and placing different emphasis on different parts of your credit portfolio, what your credit looks like. I'm more comfortable. Do I think the GSEs and Wall Street will accept Vantage Score 4.0? And if so, how soon? We are pretty embedded as an industry in FICO. I think it would take some time for Vantage Score 4.0 to come into more generalized practice. There are still, even between Fannie and Freddie, there are still some things that they look at differently. Um, like student loans, they count student loans differently. Do you have to count this payment? What percentage? So there's even Fannie and Freddie don't fully agree, right? You might get an LP is accept and your DU is questionable. So I think it would take some time for them to get on board with it as well. Although they are going to get with crypto scores pretty quick or cryptocurrency. So I do think that it would take FHFA, it would take CSBS, it would take somebody saying you have to allow Vantage scores for them to really switch. Any chance this credit scoring model could be changed so that credit score will not drop if someone has a lot of credit used, but can afford it and makes all the payments on time? Years ago, before scoring, that was okay. Yeah, it was. There was a time when you didn't put as much emphasis on the credit score. Um, in fact, there was a time, some of you may remember, when if your credit score was a certain number or above, like no income verification, no asset, stated income, stated asset. It's a riskier model overall for lenders to not incorporate credit as a factor for approval. Um, if someone has a lot of credit used, but they're making their payments, their residual income is something that can be looked at, and their impact, the negative impact, or is there an impact on their housing costs? What are we really looking at? Um, what new tech should I learn to give me an edge over other LOs? I believe, and I think a lot of you would agree with me, um, AI. I think a lot of LOs are learning how to use AI to market themselves, to um, to create programs, to write emails, to handle a lot of the little tasks that that will give them more time for the sales piece of mortgages. Is now a good time to become an MLO, an LO? I think as long as you're managing your expectations in the market, you can get licensed anytime you want to, because you can get licensed and you can stay inactive until you find the place that works for you. Um, you just can't do any loans until you get a sponsor, until you get active with a certain company. Um, I it's different, but it's similar, like a stylist. I know a lot of people that have their stylist license or their nail tech license. They don't do it anymore, but they keep it active. They keep it active so if they ever want to go back to it, they don't have to go back and do the 20 hours of or the 920 hours of education. So I would say go for it anytime. Just know what you're getting yourself into and don't rely on it right away. Um, Here's a great question too. Do I think the GSE IPO is imminent? And if this happens, will this be a disruption or offer greater efficiency? Part of what made the GSEs work so well, and part of what opened up the mortgage industry, was the fact that these were, government sponsored entities, or the government had a hand in it. If we let Fannie and Freddie just run free without any government oversight, what other investors are out there that are going to buy our loans that are questionable? Is Federal Home Loan Bank gonna buy an FHA loan with a 580 credit score? I don't know. Um, and then if it does happen, is there a chance that that they will still disrupt the market? They'll get a greater market share. It's hard to tell. I think it would be a disruption. I don't think it would be greater efficiency. I think you would see brokers and you would see those non-bank lenders having to run their loans through LP, through DU, through the Federal Home Loan Bank system, through, I think then each investor, instead of saying, oh, we'll just go with Fannie and Freddie standards, I think they would have to come up with their own standards because Fannie and Freddie standards are basically government standards. So I think we would have a lot of hurdles to get over to make it work out. I have another question. Do most LOs work part-time or full-time? Even if you're a part-time LO, you work full-time, because even if you're not doing loans, you should always be in the market, always talking to somebody, always on the lookout for an opportunity, right? Part-time or full-time as in they have other jobs. Some do. I think you are the most successful when you reach that point where you can let go of all of your other interests, all of your other work interests, and focus all of your energy and attention on being an LO. I think that's when you become the most successful. I think doing it part-time is great, and I think you can make some extra cash, and I think you can make a lot of great connections. I do think that you're going to make the most money and have the most impact on your borrowers and on your community when you switch to doing it full time. Thank you for being here today. I am excited to see what Q1, Q2, and all of 2026 brings to our industry. I've been doing it for a lot of years. I've tried to get out of it quite a few times, but it keeps just pulling me back in, right? When you enjoy something, when you feel like you're doing something and you're making an impact, I think that's what keeps bringing me back to it. And again, I'm getting a question about the recording of the presentation. Yes, there will be a recording available within about 24 hours or so. And I will leave it for our wonderful host person to wrap up if they have any last things they want to say about NAMB.
Sure. Thank you so much, Michelle. Greatly appreciate it. As Michelle mentioned, 24 hours from now, you'll receive an email directly from Zoom with a link to be able to access the recording. If they want to get a hold of you, Michelle, or anyone at the CE shop, how would they do that?
Yeah, absolutely. So I'll drop it in the chat here. I'm michelle.white at theceshop.com. Certainly they can go out to our website. And that's just www.theceshop.com.
I'm just retyping this, Michelle, because you just sent that to myself and you.
Oh, did I just send it? Sorry.
That's okay. No problem.
I am not
I know how to get a hold of you. So.
Yeah.
Alrighty, everybody. So thank you very much. Greatly appreciate all the information, and I hope everybody has a great rest of their day.
Thanks, everyone.